Okay, so today we are looking at money management. But before we actually get into the topic, let's take a look at what qualifies me to actually teach it to you. So for those of you who do not know me, my name is Tamryn, and I am the CEO and founder of Farside Accounting, which I hope the name speaks for itself. Farside Solutions, which is our training and coaching arms and includes, among other things, this business builder. Farside Foundations, which is our nonprofit supporting women building a business in South Africa. And very recently, I became the co-founder of Human Edge, which is an offshoring solution for accounting firms. So from the name of my first business, you might have worked out that I am an accountant by trade. However, my path there was unconventional, to say the least. I actually went into university to study psychology, ended up leaving without any degree and working behind a counter until I fell into bookkeeping completely by mistake. It's a long story, which you are so welcome to book a chat with me and learn more about if you really want to. But basically, I discovered that reading the story of business in numbers is far more exciting than it sounds. I promise. So I continued my studies in accounting and became a business owner, also by mistake. And I continued to make lots and lots more mistakes before I became a half-decent business owner. And now I teach other business owners how to avoid the mistakes that I made. Because business failure is a real and very present danger to all business owners. Just looking at some stats here in the US, 21% of businesses fail in their first year. It's 20% in the UK. See, 40% of businesses have failed before year 3 in the US. And in both places, 50% fail before they reach their 5th year. And in South Africa, the first year failures jump to a rather terrifying 71%. And with stats like that, I didn't even bother looking for the 3rd and 5th year stats. So globally, 80% of businesses will not see their 6th year of business. And globally, there are common reasons for those business failures. So the top 5, if we're looking at business failures across the world, top 5 is poor cash flow management. In other words, not taking the time and energy to track your cash properly. It is losing control of the finances, which is different to the cash, although most people do confuse the two. This is the accounting side of the business. Bad planning and lack of strategy, weak leadership, and overdependence on a few big customers. These are the top 5 reasons for business failure across the world. And please note that the top 2 reasons for business failure are related to an inability to manage your money, or just simply the inaction of a business owner to do so. And the 3rd reason, the bad planning, also involves a lack of money management because you cannot manage what you do not plan and measure. This means that simply taking the time to learn how to manage your money and to implement that learning will dramatically increase your odds of survival. And not just survival, it will increase your odds of thriving. And that is why you are here today. Congratulations. It's a tiny group, and that is indicative of how rare it is for business owners to actually pay attention to their money management, which is why we have this rather terrifying stat for business failure. But this care, the fact that you arrived today, is the thing that is literally going to set you apart from the millions of business owners who fail. So today we are looking at how to manage money. But before we get there, I do have a caveat. I cannot teach you how to manage your money in a single 1-hour-long webinar. So what I am teaching you today isn't the full scope of money management. It is the things you need to be aware of. things you need to recognize you don't know, start learning, and start implementing in order to be a successful business owner who manages their money. So we're going to go through 4 aspects of money management and the important things to be aware of for each aspect. And at the end, I will give you some pointers as to where I think you could start if you don't know. But I still encourage you to write all of them down, and I will share the slides and then go and learn more about them. Because the more you learn, the more you implement, the better you will be at your money management, and the better business you will build as a result. Okay. So the first aspect of money management that we're going to look at is tracking. Because we cannot manage what we do not track. You can't look after things if you don't know what they are. So if you're not recording the movement of your money, you have no point of reference in order to make decisions about that movement. And there are 2 aspects to tracking our money. There's the maintenance of your records, in other words, your bookkeeping and your accounting. And then there's the tracking of your actual cash on hand. So your bank balance and how much of it is actually yours. And I need to point out here that these are not the same thing. Most business owners do not realize that these are 2 separate things that need to be tracked. They both have to be done. They both need attention paid to in order for you to manage your money correctly. So we'll look at why these are 2 separate things. Having accurate bookkeeping records will tell you things like how much you made in sales, where your money is going, if you made a profit or a loss, how much tax you have to pay, what your company is worth, and what you as the owner can actually get out of this company. These are the things that your bookkeeping records will tell you. But if you have run your own business for more than 1 year, you will already know that your official accounting profit does not correlate to your bank account. You can tell me in the chat if you've had this conversation with an accountant before. You get to the end of tax season, your accountant has put your records together and submits your return with a profit that you do not recognize and that you have to pay tax on when you do not see that money in your bank account. Has that happened to you? Because honestly, it's happened to so many more people than you realize. Because your accounting records are a reflection of everything that has happened in your business, whereas your bank account only reflects the immediate effect of cash movements today. There are a lot of things your bank account is not telling you. It does not tell you, for example, if people still owe you money, if they haven't paid you. It doesn't tell you if you need to pay other people. It does not tell you how much tax you're going to be paying over very shortly, or how much cash you need to keep running in the future, and how much of this cash is actually yours. All it tells you is how much you have in the account right now. It doesn't tell you anything about where it came from, who might have claim to it, and whether you actually have claim to any of it. So you need to track both because they will never correlate. And what does that mean for you as a business owner? It means that you need to have your bookkeeping done correctly. Preferably hand it over to a professional. I am normally very diplomatic when it comes to this topic, and I encourage people to learn how to do their own accounts, and I think it's very important for a business owner to know how to do their own bookkeeping. I think it's very important for you to understand the process. We'll look at why later, but essentially it's a legal requirement for you to understand your accounting. So it isn't bad for you to do your own bookkeeping. But over the last couple of years, I have had to fix so many errors. So many errors by business owners who thought they could do their own bookkeeping and they were wrong. They either didn't have the time, or they didn't have the knowledge, or they didn't understand something that they needed to understand. And all that happens is that it costs you 1,000 times more in the long term to have someone like me fix your problem instead of having someone like me just do it for you in the first place. So honestly, the best thing you can do for your accounting is to get someone else to do it. But if it is truly too expensive for you, then at least spend the money on a good bookkeeping course so that you know that you are doing it correctly. If you do need a good bookkeeper, give me a shout. I mean, not only do we do the services ourselves, but I can also put you in touch with colleagues that are cheaper than us, and I can help you hire your internal bookkeeper if that is the path that you prefer. But please recognize this is something that you need. Give me a shout and I will help you fix it. However, this is not a webinar about bookkeeping. It's about money management, of which bookkeeping is an important aspect. So I'm not going to teach you how to do bookkeeping. I am going to give you some pointers to keep in mind when you are reviewing the work of your bookkeeper, or if you insist, your own work. So here's some tips to keep in mind when you're looking at bookkeeping and making sure that it has been done accurately. Do not do your bookkeeping off your bank statement. I know that many business owners do this, and it's kind of encouraged by the cloud accounting softwares these days. They tell you you can just bring your bank feeds in and categorize them. You can't. You are legally required to do bookkeeping off what is called source documents. In simple English, those are the bits of paper that prove that the original transaction happened. So if you as a business owner walked into a department store and bought pens for your office, you would have received a receipt from the store that reflects that purchase of pens and states the way in which you paid for them. That receipt is the source document for the pens now sitting in your cupboard. And when you or your bookkeeper records the purchase of those pens, you are not supposed to record the purchase from your credit card statement. You are supposed to record it off the original receipt. And that is why, if you have a good bookkeeper, you will have been harangued multiple times over the years because they're asking you for your paperwork. They would have asked for bills and invoices and receipts until you wanted to throttle them. That is because they are doing a good job. Your accounting records are not 100% accurate, and they are definitely not compliant with tax law if they were just created off your bank statements. So the first thing you need to do is set up a proper bookkeeping system and make sure that you have a way of storing your original source documents and ensuring your records were made from them. The reason for this is linked to point number 2. There are always 2 or more sides to every transaction. So when you are compiling and reading accurate accounting records, it is important to understand this concept that in accounting is called the double entry principle. In plain English, it just means that your business transactions are not one-way traffic. There is more than one moving part. So if we go back to the example of you buying pens for the office, you walked into a store to buy pens, and from a business perspective, 2 things happened. The business got more pens, but the cash reserves of the business went down because you had to pay for those pens. So there were 2 sides to this single transaction, and that applies to every single transaction that occurs within your business. There will always be a minimum of 2 sides. There could be more, because maybe you bought more than one item and it goes to different categories, or you're VAT registered and you have to account for that. But there will never, ever be less than 2. There must be 2 opposite and equal sides that balance. That is why bookkeeping is called balancing the books. So please bear that in mind when you are capturing and when you are assessing your records. There must be two sides to every transaction, and you need the source documents for both sides. So the receipt is the original source document for the payments increasing in number, and your bank statement is the original source document for the payment of that receipt. And you need to have all your original paperwork, that is statements and receipts, when you are handing your work over to something like the taxman or to an auditor. It is extremely important. Every single tax authority in the world requires you to keep your paperwork and to be able to present it to them as proof when requested. They also require you to keep that paperwork for a number of years after the transaction occurs. So the exact number of years will depend on your country's legislation, but it will be a minimum of 5 years. So make sure you are keeping your receipts, keeping your bank statements, using them to create your records, and then keeping them safe in case the taxman comes looking for them in the future. The next tip is to use proper software. Please do not muck around in Excel. I do not say this because Excel is a bad program. Excel is an excellent program, but you are not a finance professional who has been trained in Excel, and even finance professionals trained in Excel make mistakes in Excel. And mistakes in your basic records will be exceptionally costly down the line. There are also a lot of accounting things that Excel just doesn't do or doesn't do easily. So use proper accounting software. You have no excuse these days. Gone are the days when you had to invest 20% of your financial budget in buying your software. Cloud accounting has made world-class software available to you at extremely affordable prices, and they made it easier to use. So choose an accounting program that you find user-friendly and you find easy to understand. Sign up for the monthly subscription and keep proper accounting records. It doesn't just reduce error, it also provides you with a complete history of transactions. It makes it easier for you to run reports. And cloud software in general comes with a massive number of benefits like good cybersecurity protections and automations and integrations and all sorts of things that help you to streamline your operations and save time. They'll also help you improve your decision making. So please do yourself a favor, use proper accounting software for your accounting records. Don't keep doing spreadsheets. The next tip is to do it regularly. Do not have your accounting done once a year just ahead of tax time. Yes, this will meet your legal requirements, be 100% compliant, but it is completely useless to you as a business owner who is trying to manage your money and keep your business in business. Bookkeeping needs to be done regularly, preferably weekly, but at least monthly, so that you have up-to-date, accurate information that you can pull when you need it in order to make a decision. The world changes all the time. The rate of change these days is terrifying. You cannot use last year's figures to make a decision about tomorrow. Your decision will be wrong. You need to use last week's or last month's figures to make a decision about tomorrow. If you are still clinging to doing your own bookkeeping, please religiously schedule time to catch it up every week. If you have given the responsibility to a professional, check in with them to make sure that they are doing it at the intervals that they promised you. But do not wait till tax season and hand your tax consultant 12 months of bank statements. It's the absolute worst way to manage your money, and I promise you it will result in you paying more tax than you have to, and it will cost you massively in the long run in other ways. The final tip I have for you is learn how to understand your numbers. Very few business owners realize that it is your legal responsibility to ensure that your accounting records are accurate and a true reflection of reality. In every country of the world, the legal responsibility is on you as the director of your business to have accurate financial statements compiled and to be able to read and understand those records. And it is up to you to ensure that they do truly and completely represent the transactions that occurred within your business. It is not the responsibility of your bookkeeper, your accountant, or your tax consultant. Hopefully, you have good bookkeepers, accountants, and tax consultants, and they've done the right job, and it is accurate, and you can rely on their numbers. But the responsibility is yours. A court of law will hold you personally responsible for errors and omissions in your financial statements. So it is very important that you know how to read them. But I can give you an even more important reason for you to want to understand them. It is so that you can use them to build a better business. Because how do you know if the price you're charging is correct? How do you know if your time is profitable? How do you know if you're actually making any money, if your business is worth anything? And if you're growing, how do you know you can afford your growth? You cannot know any of these things unless you are recording the numbers correctly and then analyzing the reports and understanding what they tell you. So again, this is not a webinar on bookkeeping, and I'm not going to go into detail about the reports here. We do have some recorded webinars already about understanding numbers, so you can please go look on our YouTube channel. You'll see some there. If you're a member of the Business Builder, you already have access to a lot more training that covers things like reports. So you can have a look in the Learning Library, or you can drop me a mail and I'll direct you to where to look. But take the time to learn to understand your accounting reports, because too many business owners come to me and say things like, oh, I hate maths. I'm bad with numbers. I want you to handle it for me so I don't have to worry about it. Now, that's fine. You can get a professional to handle it for you so that you don't have to worry about it. And there's plenty of professionals out there where you really don't have to worry about it. We do a good job. And that's a good move, because this is not your primary function and you don't want to spend your life doing accounting records. But you do still need to learn to read them, because you cannot manage your money or your business if you don't know how to read the accounting reports that tell you what happened. So I'm going to look very briefly at some of the important bits in these reports. There are 3 reports that every single business owner should be able to read: income statement, the balance sheet, and the cash flow statement. There's lots of other reports, but those are the 3 you really, really should know how to read. Your balance sheet tells you what your business is worth. So if your plan is to build a business that you want to sell one day, you want to know how to read a balance sheet. But it is also important to remember that what a business is worth to a potential buyer in the future is also what it is worth to you right now, which means the value of your business is a very important thing to track. And therefore, a balance sheet is very important to know and understand. It will help you to build a better business and a better future if you know what you are looking at. The cash flow statement tells you what is happening to the flow of your money through your business. So it's not giving you a record of what is in your account right now. It is telling you how that money moved through the business itself, which will tell you about your spending habits and whether or not you are using your cash wisely to grow the business. And the income statement, which is often called the profit and loss statement, is called that because what it shows you is whether you made a profit or a loss. And it is the report used to calculate your taxes. So I'm only going to go over the income statement in detail here. And even then, I've used the word detail very loosely. But please reach out to me if you need help understanding the others. So the first section of an income statement is the sales, the revenue. This is all the income you made from your normal trade. So if, as an example, you are an architect, this is all the invoices you send to customers for designing buildings. Okay, but not all your income, well, maybe not all your income is from your main trade. So somewhere on an income statement, you often see something called other income or other operating revenue. And that is from side sources of income. So in most businesses, it's interest earned because it's income, but it's not related. You're not a finance house, so it's not related to what you do. But if, for example, this architect has designed and had a cottage built on their property and they now rent that out for extra income, the rental is not their main source of income. Their main source of income is designing buildings for other people. But you still need to show that rental on the income statement, so it goes here under other income. Depending on your software, the other income could be below the sales at the top, or it could show at the bottom of the statement. It doesn't really matter. What is important is that you see sales and that you see the next section, which is called cost of sales. Now, cost of sales are most common in product-based businesses because they are what they say they are. It is the cost of producing and selling your product. So if you are a carpenter that makes and sells chairs, the cost of wood, nails, glue, varnish, all the items you had to buy in order to make the chair are your cost of sales. It's the cost that you have to produce and sell your product. They are less common in service-based businesses. Most service-based businesses think they don't have cost of sales, and you don't in the traditional view. You're not selling a product, so you don't buy materials to create it, and you don't buy and resell a product. So you don't have direct cost of sales. However, there are costs associated with providing your service, and it is worth tracking them as cost of sales because it helps you with your pricing. So, for example, it could be your salary if you are the person producing the service. If you're spending your time with your clients, then the salary you draw out of your business is directly related to that service you are providing. So that could be your cost of sale, or it could be the salary of a significant team member, or perhaps you outsource some of the things that you do. For example, I know that Neil is a web developer and does websites, but I'm very sure he doesn't create the pictures for the websites. He outsourced that to a designer. So that would be a cost of sale, even though there is no product involved. It is worthwhile thinking about what it costs you to provide your service, because it will help you to make sure that you are pricing correctly. Because the next figure we're looking at is the gross profit. Now, gross here does not mean, ew, get it away from me. It means large and big and before deductions. So your gross profit is all of your income, less costs associated with creating that income, and that results in the money that your business actually makes. Your business then has to use this money to keep itself in business. And that is why it's worth spending time thinking about what your cost of sales are, even if you're in a service business, because it helps you to determine whether your business can actually fund itself or not. The next section is the operating expenses, and these are all the costs of keeping your business running. So rent and bank charges, accounting fees, the administrative salaries, your office purchases, etc. This part of the income statement shows you where all of your hard-earned money is going. And down at the bottom, we have the net profit. That is the amount of money you have left after everything has been paid. So gross profit is the amount of money that your business has made from the sale, but net profit is the amount of money your shareholders have made from the sale. For most of you, you are the shareholder. So the net profit is not your salary, although I suspect a large number of you aren't even taking a salary, but your salary is remuneration for work done for the business, therefore it is a business expense. Profit is how much you made from the business as the owner, which makes this the number one and most important number for you as a business owner, not your sales. Too many business owners are constantly trying to increase sales without paying any attention to their profit. And you can actually have increasing sales and have decreasing profit if you are not managing your money correctly. We will look at that a bit closer later on. But that is your income statement in a nutshell. Please learn how to read and understand your financial reports, learn how they differ from each other and from your bank statement, and how they fit together to give you a picture of what is happening in your business and guide you in changing that picture into something you want. If you want someone to teach you, give me a shout. I love teaching people how to read and use their numbers. But aspect number one of money management is tracking, which we can summarize quickly as keep your source documents, do your bookkeeping from them in a proper system, do it regularly so that the information is useful to you, learn how to read that information and use it for decision making, and track your cash as well as maintaining your records. The next aspect of money management is planning. Because now that you have your records of what has happened and you know how to read them, you can start using them to plan for the future. You can use your accounting records to create a budget and a growth strategy. You can use them to create a strategy for increasing your company's value or a strategy to increase the amount of cash that you have on hand. There are all sorts of things that you can do using those numbers. But because we are looking specifically at money management today, the one I'm going to focus on is increasing cash, and that is by creating a budget. Now, budgeting tends to scare small business owners, but I promise you, you do not have to be a financial genius to create a budget. Budgets range from simple to complex, and while your accountant might do a complex one for you, it does not matter how simple your personal budget is, because it still results in better money management than having no budget at all. So all you need to remember when creating a budget is that you want to roughly know how much money should come in, how much money should go out, and you want to know where it goes out and that it is going to the right things. That is why we budget. We want to know that we are spending money on creating more money in the future. There is obviously always a survival aspect to our spending. We have to spend money to keep in business, but we should also be spending money on creating growth, both for the business and for ourselves. And a budget helps you to do this. Because if you can define what your survival costs actually are, then you can control them and you can see how much you have over and above those survival costs that you can put back into creating more wealth in the future. So your first step in creating a budget is to have accurate bookkeeping records because we need the history to work from, but we already have that covered. Now you can take last year's income statement and use it to work out your average income and your average expenses per month. That is your actual spend from last year. Then I want you to take that same income statement and work out what you would prefer them to have been. In other words, what would you have liked your sales to be? What would you have liked your profit to be? Work out what is the picture that you're aiming for. And your third step is to bridge the gap between the two. So you're going to work on those figures to work out how you can go from the one to the other. Do you need to increase sales? Do you need to reduce spending? Do you need to spend in a specific area? So for example, if you want to increase sales, you might need to increase your spend on marketing. So you need to look at all of these things and go, how do I go from where I was last year to where I would like to be at the end of this year? And that becomes your budget. Now, in order to get a budget correct, I recommend you start with what I call the survival figure, and I use capitals on purpose. Your survival figure is the minimum amount that you need to survive every month. Not thrive, not feel successful, just survive. That is you and the business combined. The absolute minimum amount that keeps you alive. So, if you want to, you can try and do this with me now, but otherwise, please, I will share the recording and you can come back to this later and do yourself a favor. And if you do nothing else from this webinar, create your survival figure. We start with you personally. So to create your personal survival figure, I want you to go get your personal bank accounts. If you, for some reason, can't access them, do your best from memory, but rather use your statements and make a list of all the expenses that you have to cover every single month. So how much do you spend on your bond or your rent every month, including rates and utilities? How much do you spend on food? That's both your groceries for home and your eating out. Try listing the eating out and the groceries as separate figures if you can. How much do you spend on grooming? So clothes, hairdressers, beauty salons, etc. How much do you spend on your various insurances, your medical insurance and your house insurance and your car insurance? How much do you spend on communications, your mobile phones, if you still have a landline, I don't know if anyone still does, and internet connections? And how much you spend on your daily travel. So that's fuel for your car. If you don't own a car, it's trains and Ubers and buses and taxis, and so on. List all of the things you spend your personal money on as an average amount per month. If you are in a relationship and you share some of these expenses, so for example, you share the rent half-half, please record your portion only, because that is now your personal budget. And it is also the absolute minimum amount that you need to take out of the business as earnings. You don't take that amount out of the company, you can't meet your monthly expenses. So that is your personal budget. Then you are going to take your financial reports and you're going to do the exact same thing for your business. How much does your business have to spend to stay in business? So these are the costs that happen every single month, regardless of whether you make a sale or not. So it's your office rental, your phone, your internet, staff costs, and things related to staff like teas and coffees and toilet paper, software subscriptions, business insurances, business debit orders. List every single expense that occurs in your business that has to be paid, that is going off your account, regardless of whether you made any money or not. And next to those expenses, put your average monthly spend. If it is something you pay annually, so I know a lot of businesses pay for software subscriptions, for example, annually because you pay less. If you've paid for something like Zoom or Calendly or even your insurance as an annual figure, then divide it by 12. So you have your monthly portion. And then add up all your business survival costs and add them to your personal survival costs. And this is the survival figure with the capital letters. This is the absolute minimum amount that your business has to bring in every single month in order for you to just survive. And we haven't even taken taxes into account yet. That's a whole other problem. To add them to your survival figure, I would say add another 25 to 40% to that figure and just bump it up that way. So now you have the basis for your expenses in your budget, and this is your total survival figure. It is your minimum goal for monthly income. If you haven't fallen over in horror by the time you have your survival figure, good. That means you are confident that you can bring in this amount of money every month, and that's a good sign. If you look at your survival figure and you find yourself starting to sweat and hyperventilate, the good news is that this figure can and should be refined. So you've created your basic budget. It's now time to refine that budget. You're going to spend time analyzing these amounts and being very, very honest with yourself. Can you reduce your spending on eating out at restaurants? Are there luxury items you can temporarily stop buying? Can you get hold of your insurance provider and have your insurance reduced? By the way, this is something that very few people even know is possible. Most people just accept their annual increase from their insurance provider, but you can actually phone them and request to have it reduced. Many of them probably will do so if you did not have any claims in the years. Not always, but often. Can you find a cheaper supplier for the items that you buy regularly? Can you switch some of your monthly subscriptions to the annual plans? Obviously, that requires having cash on hand to pay that annual fee, but it will save you money in the long term. Are there subscriptions you're paying you don't need? Are there debit orders going off your account that you actually forgot you had? Cut them. If you have a team, then I also recommend spending some time reviewing your financial controls. In other words, the way in which money flows within the business and who is involved. Make sure you have ways to prevent theft, to prevent fraud, and to prevent frivolous spending by team members. Review how your orders are placed, how they are authorized, and how they are paid. Make sure that you have control over the flow of money within your business, even when you are not involved in the actual process. If you want help with financial controls, give us a shout. But there's also lots of information on the internet if you're not sure where to start. Spend a good few hours reviewing these expenses and, where necessary, be brutal. I promise you, you will be able to reduce your survival figure. And if you do, and you were drowning before, you might find that you can suddenly tread water. If you were surviving and you cut this figure down, you suddenly have budget for growth. You have money you can spend on making more money. Now, that might be on something like a marketing agency or a salesperson, but it also might be an internal cost like an accountant or a virtual assistant that will take things off your plate so that you have more time to spend on clients making more money. So do yourself a favor, block off half a day on your calendar and work out your survival figure. Then work on reducing your survival figure to the lowest amount you can get it to, and turn those amounts into your budget with scope for growth. The next thing to remember with a budget is that it is only useful if you stick to it. There is no point in allocating $500 a month to meals and then spending $750. You are just going to end up in trouble. So you do need to stick to your budget. You need to be disciplined in applying it. And you also want to see results. So if you are going to be spending money on growth, you want to see growth. So you want to be tracking the spend every month and looking for the return. If you got yourself a virtual assistant, how many hours did you get back in the month? How did you use those hours to make the business better or to make more money? How many leads did your marketing agency bring you, and how many new sales did your new salesperson actually make? Managing spend is also about managing results. When you allocate money to growth, you want to see it produce growth. Otherwise, it's just a waste. So creating a budget is step one. Step two is monitoring the spend against that budget every single month and making sure you stay within the parameters. The only parameters you want to go out of is sales. You want to see more sales than you budgeted for. You don't want to see more spend. But you cannot manage what you do not plan and measure. So create the budget and then monitor your spend against the budget, and that will help you know whether the budget is actually viable. So aspect number two of money management is planning. And again, we summarize as track your spend, implement your financial controls, create a budget for growth as well as survival, and then monitor your spending against that budget to make sure there is a return. Because using a budget properly will result in creating growth for your business and being able to afford that growth so that you get to take more money home. And as part of that growth strategy, I want you to implement the third aspect of money management: forecasting. So budgeting is about predicting your income statement. In other words, a budget predicts your accounting records. But you also want to predict your cash flow. Both your cash flows into the business and your cash flows out of the business need to be tracked on a regular basis. I did mention earlier that your survival figure represents the absolute minimum amount of money you need to survive. So you need to check ahead of time that you will have that amount of money in the bank when you need it. And we do this by forecasting. Now, again, forecasts can be simple or complex. And yes, your accountant can create a much better complex forecast than you, but that does not mean that you can't create your own. You can make it as simply as you like. All you need to know is who owes you money and how much, and when are they going to pay it to you, and who do you owe money to, and when do you have to pay it. And that's all you need to know to create a forecast. You're going to project that information into the future so that you can plan ahead. That's literally all you have to do. You want to see your money coming in and going out over time, and at what dates it's coming in and going out. And that way you can check for periods of drought. You see there where the income is much higher than the expenses, and periods of plenty when the income is higher than the expenses. Oops. There we go. Because that will help you to plan ahead for the drought times using cash that you saved up in the plenty. And that is the power of forecasting. It gives you the ability to pay your expenses every month from the months of plenty. So when you're creating your forecast, I want you to remember the following. You need to account for your monthly in and out, which is your survival figure. But you also need to account for your annual in and out, because there are things that we pay once a year. You cannot forget, because these things do not show on your income statement, do not forget your taxes. PAYE, VAT, sales tax, income tax, all of those will need to be paid, and not necessarily in the month that they were incurred. VAT, for example, is every 2 months, so you've got to remember to keep that money aside. And you want to have savings provisions for the unexpected and bad times. You can use forecasting software, you can use Excel, you can use pen and paper and pictures. I don't care how you do it, but make sure you take the time to make yourself aware of how money is flowing into your business and how it flows out again, and the time periods in which this happens. It does not matter what format your forecast is in, so long as you have one and you know how to use it to predict when you will have money and when you will not, so that you can make a plan for the times that you don't. So here are my suggestions on how you use your forecast to manage your money. The first thing we say that you're going to need is a proper system for collections, because getting paid is the number one challenge of small businesses. I think it's something like 63% of businesses battle to get the money in after doing the work, and it can be overcome. If you want to learn more, I did an entire webinar on collections. I will try to find that link for you. I'll put it in the slides when I share them later. But collections is something you really, really want to spend some time on, making sure that you have a process for getting paid. And the next thing you want is a separate savings account to plan for your taxes. Now, if you have up-to-date accounting records, you can plan ahead for your VAT and your income tax. So you can put aside some of your money every single time a client pays you. You can take some of that aside, put it in another account, and when your taxes come due, you have them and you can pay it without worrying. The other thing we recommend is another savings account where you can put a provision for your annual expenses. So that software that you pay in advance, you already divided that up by 12 for your survival figure, so you know the monthly portion. Move that monthly portion into a savings account every month so that when the debit order comes due, you have the figure. And yet another savings account. Yes, my business has a large number of savings accounts, in case you're wondering, but have a separate savings account for the unexpected. You want to put money away for the rainy day. It can be tiny. You can put $50 a month in there, but just make sure you put something away regularly, because no matter how small those savings are, they might not cover the full unexpected expense. They can make a big difference towards it, as opposed to having nothing. So have your systems for collections, have your savings account for your taxes, your annual expenses, and your rainy day. And if you see that your savings are not going to bridge the gap, you can consider things like bridging finance. If you know that the money is coming in, bridging finance is a very nice way to get through the end of the month. But do be aware that all borrowed money costs you a lot of money. It's not free to borrow, and it can hurt in the long term. So only borrow when you have no other recourse. And if you borrow, remember to add the loan repayments to your forecast so that you can pay them when you need to. And the last aspect of money management is measuring, because we can only improve the things that we measure. We don't have a standard to measure against, we won't know how we're doing. And if you leave your growth to chance, it will never happen. So set yourself growth goals. First, you aim to cover your survival figure. Then you aim to have growth expenditure on top of the survival figure. And then you aim to have some really nice take-home profit over and above all of those expenses. And once you've set your goals, you need to measure your progress in achieving them. How close are you to actually achieving those sales figures that you've worked out you need? Measure the impact on the goals that you set. On your expenses, because growth costs money. So you need to make sure your growth isn't actually costing you more than the growth itself. So measure how close you are to achieving your goals, and measure the impact of your goals on your expenses. Check your actual cash flow against your budgets and your forecasts. You should be doing this at least once a month. You want to check that you have accurate and reasonable budgets and forecasts, and you need to check that you have reasonable and attainable goals, and that you're not being wasteful in your spending. And you need to check that your spend on growth is resulting in growth. As part of this measuring process, there are specific numbers that are really, really very important to keep an eye on. And I actually go through them in detail in another webinar, and that one I remembered to have the link ready for you, so I'm going to pop it in the chat here. This was all about numbers that you could track for success. So I'm not going to go into these in detail. I highly recommend you read that webinar because I promise it will make a difference to your bottom line. But a quick summary of the 3 most important numbers that you must measure in your company. The first is sales. Now, I actually don't need to tell you to track your sales. Every business owner tracks their sales. For most business owners, it's the only number that they track. So I know you're already tracking your sales, but if you don't have sales, you don't have a business. And if those sales are not regular and growing, then you're going to reach a moment in time when you cannot afford to pay your bills and you have to close your doors. So you want to see sales, you want to see them either steady or increasing. Keep an eye on your sales, but remember that the sales are not as important as you think. The number you need to focus on religiously is profit. Profit is the whole reason you opened this business in the first place. It was so that you can make money doing something you enjoy doing. Profit in the company is the money that you make. It is very possible to have a company turning millions and to run at a loss. This happens when a business owner is not paying attention to the profit. I sat with a client last year and I actually showed them that if we analyzed their numbers, you looked at their sales and their cost of sales, their gross profit, their net profit, then for every 1,000 Rand that their business made, the business got 390 Rand to run itself. And at the end of the day, her and her partner got 2 Rand each. They earned 2 Rand each from every 1,000 Rand that the business sold because they were not managing their money. So it is important to track these things. It's important to focus on your profit. And the most important, profit again should be steady or increasing. Okay, so you can actually as well, this is something else, just as a side note, is that you can actually increase profit without increasing sales. If you are wise with your money management, it is possible to make more money without working harder. I have an entire series, there we go, there's a link, it's another link I saved. I have a series on YouTube about working less and earning more. There's the link for you in the chat. Do yourself a favor, watch that, because you can actually improve your profit without working harder to get more sales in. So, and it's worth remembering that. But your most important number is your gross profit percentage. Now, I think the word percentage means I just lost any of you that hate maths. But I promise this is a very simple calculation, because to work out your gross profit percentage, you take your gross profit off your income statement, you divide it by the total sales, and you multiply it by 100. That's all you have to do, and there isn't a wrong answer, because it doesn't matter what the number is. What you want to track is whether it is getting bigger, smaller, or staying consistent. You want to see your gross profit percentage staying the same or getting bigger. Because if your gross profit percentage is going down, your company is dying. Now, I go into that in detail in the other webinar, the Tracking for Success webinar that I put in the chat. So please watch that. But for the purpose of this webinar, all you need to know is that when you're measuring your numbers, you want this number to stay the same or go up. I cannot emphasize this enough. The moment it starts decreasing, call an accountant to help you. You'll preferably want to get an accountant in before it starts dropping so that it never starts dropping. But if you see it sliding, call for help. Do not ignore it. I'm not being dramatic. A dropping gross profit percentage is the death knell for your business. So track this, make sure it stays the same or it's going up. Okay. In summary, your 4 aspects of money management is tracking, planning, forecasting, and measuring. If you found this webinar overwhelming, remember it was not designed to make you into a money managing expert. It was designed to make you aware of these aspects of money management so you can learn more about them and start implementing them in your business. If you are feeling lost and you have no idea where to start, then there are 2 things that I recommend. Start with your bookkeeping. Get your bookkeeping sorted. It is vital. You cannot do any of the other steps without accurate and trustworthy figures to work off. None of them will work if you don't have proper bookkeeping records. So sort out your bookkeeping and then sort out your survival figure. Then you can use those bookkeeping reports to ensure that you're covering that survival figure every month. That is where you start if you don't know what else to do. If you have bookkeeping records and your business is making a profit on paper, but you never have cash in the bank, give me a shout. We have a cash flow assessment product that we can do with you. We will work you through what is happening with your cash. We work out what is going wrong, what is going right, and we give you steps to fix it. I'm going to be opening the Q&A up in a second, but if you are watching the recording and you want more than 2 minutes, or right now you need more than a 2-minute answer to a question, please book a virtual coffee with me. My virtual coffees are 20 minutes long on my calendar, and if I can help you in those 20 minutes, it's free, so you lose nothing. So book a call. Let's see what we can fix for you in 20 minutes. Managing your money is a continuous process and it needs to be done regularly, and you constantly need to adapt to a changing environment and to the results of your measuring. If it scares you or you're overwhelmed by the concept, get someone to help you. That is the real reason accountants exist. It isn't to help do taxes, it's to help manage your money. So if you want help, give us a call. If we aren't the right fit for you, I will find someone who is. But whatever you do, do not put your head in the sand. Do not keep focusing on client work and ignoring what is happening with your bookkeeping and your cash flow. Take control of your finances, manage your money, and I promise you it will result in a better future with less work, more profit, and far less stress. Give me a shout if you need help. Otherwise, I am going to end this webinar officially and open up for Q&A.